Welcome back to the Our 2 Cents podcast, the show where your local professionals sit down with an array of guests to hear their story and impart some wisdom for both business and life-improving skills. This is your place to hear business and community leaders discuss relevant topics that matter to you.
Mike, Mary, welcome to the program. Thanks a lot for coming in today.
Thank you.
We really appreciate having you guys here, and I think it's pretty timely with everything that's going on in the banking industry, financial industry, nationwide, worldwide. There's been some bank failures. There's been all kinds of, I think, worry and turmoil in the financial services industries. Have you guys seen some of that just from maybe some of the worry or the fear up front with customers that you guys have at Safe One?
You know, when it first happened with Silicon Valley Bank, it happened over a weekend. So with our senior team, we met, that Monday, what's going to be the concern? Are people going to start really asking a lot of questions? Fortunately for us is our business model is so much different than Silicon Valley Bank. They worked with a lot of the fintechs, a lot of startup companies, and our business model is we're much more traditional. We're retail. We deal with consumers on an individual basis, and so that was a conversation we had, and we just wanted to kind of wait and see. Did we get a lot of questions? And we did get some. We certainly weren't overwhelmed by any means. I think the people that bank with Safe One know that we're financially sound. And so I think that alleviated a lot of their concerns. But Mary, for instance, would get more of the individual calls from people. But I think overall, I think you'd agree, it was not a whole lot, not overwhelming, but definitely some people that were concerned, not just maybe with Safe One, but just the banking system in general. So they definitely wanted to make sure, hey, their first concern is, hey, is my money safe?
Yeah, right.
It's great if the world blows up, but I want to make sure my money's okay.
That's right. Is my money safe in Safe One?
Yeah.
Right. Mary, you've been doing this a long time. Maybe you can tell us a little bit about your background and how you got into the industry.
Sure. So I've been working for Safe One for almost 35 years. I started as a teller and kind of grew up through the system. Been in almost every department of the credit union. So that's
and
how
you're
I started.
Currently in compliance, right?
Yes, operations and compliance. It's kind of a different combination, but it works.
Well, you're probably pretty well versed then in the ins and outs of insurance on accounts. Not FDIC insurance in this case, because you guys are a credit union, right? So maybe you can tell us a little bit about how credit union bank accounts are insured.
Sure. So most people confuse insurance with accounts versus account types. So at the credit union, there are three basic types. You have a sole ownership, you have joint ownership, and then you have a trust ownership, which also could be a pay on death type of account, which is a beneficiary account. So it's based on the account type that you own. So if you have an account where you're just the only person that owns the account, you're insured up to $250,000. If you have an account in which you and your spouse or somebody else is joint on the account, then each person is $250,000 each. So that's $500,000 on a joint account. But remember, you can't put beneficiaries because once you put a beneficiary on the account, it changes. So if you add beneficiaries, you yourself insure the beneficiary. So if you have two beneficiaries, if you have two people on an account with two beneficiaries, that could be $1 million in insurance because you provide $250,000 to the first beneficiary. The other person provides $250,000 to the second beneficiary, and the same goes for the other beneficiary.
I see. Now, that's exactly why I asked that question, because it's not just a straight yes or no answer or a single dollar amount, because there are some nuances. I mean, that's why it would be really important to talk to you about that when you set up your account. Do you happen to know, is that also true in the banking world with FDIC insurance? Is there kind of a similar parallel there as to how that's set up?
Yes, I believe so. I don't know the ins and outs of FDIC, but I have heard that it's set up the same.
Okay. Do you think that there is overall do you think that the credit union, what is the credit union insurance called? If it's not FDIC? It's
NCU, well, it's insured by NCUA, so it's NCUSIF.
Okay. So in the NCUSIF, is there any indication that is more or less safe, sound, secure? I think this is kind of the worry that's out there a little bit, is that FDIC insurance is good, but how good, and how many banks can go under without breaking the bank, the big bank?
Yeah.
Do you have a sense of how stable credit union insurance is?
Well, I do know one thing that the NCUA promotes is that no one has ever lost any money in a credit union. So that would tell you that we're extremely strong. Yeah. As for, it is backed just like the FDIC, so we are backed with the government.
Okay.
With the federal government.
And as it's advertised, 250,000 FDIC and NCUA, that's the same. And as Mary just pointed out, you really can be insured beyond that 250,000.
Yeah, you sure can.
So
I wasn't aware of that.
Like you said, they're parallel. They're completely comparable.
Yeah. Do you, just knowing what you guys know about the local banking environment, do you think that here locally, Bakersfield, Kern County, that we will see banks struggle, or any particular, not naming names, but just do you think we'll sense or feel this banking crisis here locally, say coming months, coming years, where we see some maybe not, even if not runs on banks like we saw with Silicon Valley Bank, will we see them get strained by moving deposits around? Well,
right now in the rising rate environment that we have, all institutions are kind of monitoring one another, and we're looking at ourselves to make sure that we're properly priced because, for instance, we have a certain CD or certificate that we have right now to keep us competitive in the marketplace. I think what's happening now and what happened with Silicon Valley Bank was this rising rate environment affected them because, and all of us, because one thing we do as a financial institution, whether you're a bank or a credit union, we do the same thing. We bring in deposits and we lend the money out. And we lend out as much as we can to the community or whatever types of consumer groups that we lend to. And if you can't lend out all your full amount of deposits, which most people don't, most banks and credit unions will go to 80-85% of what they bring in with deposits. That's what they'll lend out. But if you can't get to those thresholds that you have, then you use those funds to obtain funds in other ways. In other words, draw interest in other ways. So what happened with Silicon Valley Bank is they went and they bought securities. Mm-hmm. They went and bought securities in order to compensate for that income.
I think they bought like treasuries, right? Like
that's
5-year,
exactly
10-year treasuries, yep, where they were earning some interest.
Exactly.
Right? Securely earning interest on their investment, right?
Yeah, and so what happened is from the time they bought them, and you just noted that they were 5- and 10-year treasuries that they purchased. Well, probably not a good decision in a rising rate environment. You probably will only want to get 2- to 3-year treasuries because as the interest rate environment rises, the value of those treasuries has gone down. So what they had to do is they had to realize on their balance sheet a loss, either your gains and losses on your investments, and that's what happened with them. So they had to disclose a loss of, I think it was $1.8 billion because their biggest issue is that they had such long-term treasuries that they purchased. They weren't short-term, like 2 or 3 years. They were, as you noted, some of them were 10 years out. Yeah. And so that's really what caused the issue.
Do you think it was just as much the fear that was created by that big loss that they posted?
Absolutely. That definitely tied in.
It's kind of a classic, like it's a run on the bank essentially, right? Like from 100 years ago.
It's exactly. It's exactly what it
was.
Isn't
that wild that can happen?
Oh yeah, and that's exactly what happened. Yeah. They had to realize that loss, and then what happened is it gotten out that they were going to issue new stock, and when that came out, then it's like, they're in trouble. I better get my money. I think over 90% of the deposits in that institution were uninsured.
Because they were higher than the $250,000 balance.
Beyond the $250,000, and I think there were several large fintech companies that had literally hundreds of millions of dollars. Yeah, that's their operating capital. Yeah, and had the government not stepped in, then there would have been companies failing,
huge losses,
layoffs, all of it.
Yeah.
So the chief difference between like banks and credit unions is we don't issue stock. The funds that we borrow, that we lend out, come from people that deposit those funds.
So tell me about that.
Yeah.
So there's not stock, how does the ownership work?
The ownership is anyone that comes in and opens a share account, a savings account with the credit union. They are owners of the credit union.
So, I've seen that on credit union account statements. It's like you are an owner. Here's your shares of this organization, right? Yeah. And so truly it's ran in as a share. The depositors are the shareholders.
It's exactly it. They are the shareholders as opposed to someone who buys stock. Yep. Because you could be a stockholder in a bank and not necessarily be a customer. Yep. In the case of credit unions, if you open that share account, you are a member owner of the credit union.
Okay. And other than that, is there still a board of directors? I imagine
Yes.
it's got to be ran by a board, and
Absolutely.
there are still these decision makers that are elected, I guess, by the
they're
depositors.
elected by the membership. Yeah. The chief difference is that you take a bank and their board of directors generally are the big stockholders in the company. So their interest is a little bit different. They're generally well compensated for serving on that board. So not only are they paid in the sense that if their stock value goes up, they obtain profit from that, but they're also paid to serve on the board, as opposed to credit unions where our boards are completely volunteer. They are not paid anything to serve on the board. They do it because they believe in the credit union cause. They do it because they want to be a part of the community development. And so that's the chief difference. Is it's not for profit. We're really for service.
Okay.
And that's kind of a driving force, not for profit, but for service.
Okay.
I like to say that we cut out the middleman. So we don't have the investors that we have to keep happy. Only people we have to keep happy is our members. And that's how come we have the lower rates in loan rates and higher rates in certificates, usually lower fees.
Do you think that the financial industry as a whole, the banking industry as a whole, would be better in a credit union model? I know you might. You have a biased opinion.
Yeah,
I know.
we're biased. Absolutely.
I threw you a softball there.
Yeah.
But objectively though, what is the motivation to continue in a banking shareholder sort of structure when the credit union seems to do a pretty good job of that without, like Mary, you say, cutting out the middleman?
I think when you talk about the average consumer, credit unions are of much better benefit to them for the reasons Mary just mentioned. Because of our structure, we are allowed to have lower fees. We have better rates on loans. We have higher deposit rates as well. So if you think philosophically, yes, it would be much better for the consumer if everyone was a credit union. But we do live in a capitalist society. So a stockholder wants to make a little bit more return on their investment. And so that's why you kind of have, you have different models. I remember listening to the head of the Department of Financial Protection and Innovation years ago. It was had a different title, but that's what it is today. And one thing he talked about is that he or she has to always look at all types of institutions. So you have credit unions that are one pillar, banks that are a pillar, even your payday lenders are a pillar, your thrifts are a pillar. So we all operate under different type of philosophical ideals. So really, it's up to the consumer to determine what's best for him or her. Obviously, like you said, we're biased. We think credit unions are for everybody and everybody benefits from it. And the more people that are members of credit unions, the better and stronger that credit union is.
Do you think that credit unions serve better the personal account and the individual depositor and user? Or do you have a pretty good suite of business services as well? Do you even market to, are you even interested in the business customer in the same way?
It varies amongst credit unions. At SafePoint, we focus on the retail, the consumer, the individual. But there are lots of credit unions in the nation that have taken on business accounts, and to varying degrees of success. Some are very successful at it, and some have struggled doing it. It really would depend what type of business you have and what type of specialty you need. Mm-hmm. Obviously, a business, say like a Mission Bank, or it was Valley Republic, now it's Tri-Counties. Yeah. Their specialty is just that. That's all they do is business accounts. They probably have a little bleed over on the individual side as well. But if you can get a bank that is tailored to what you're looking for, the better off you're going to be, because they have an expertise that can help those business owners, as opposed to other businesses who are trying to maybe take on multiple types of financial offerings.
Yeah, understandable. So in a little bit of an overview analysis that I've looked at with the Silicon Valley Bank failure, the other ones that are related and for related reasons, it seems that the number of accounts, or the amount of money held in deposit that was over and above that $250,000 threshold, had a lot to do with whether or not they were at risk of failing, because you can sort of look at their balance sheet, you start to understand very quickly that they are at risk because people are going to obviously move money out of that bank into a bank that has the FDIC insurance, or spread it across multiple accounts. So when you look at your own balance sheet, when you look at your own structure and the way you mentioned how you guys make investments when you take deposits in, do you happen to know your percentage of accounts under the $250,000 threshold, or some safety measure? Have you guys taken an internal look there? And what does that look like?
I think all financial institutions, in light of what happened with Silicon Valley Bank, wanted to look right away like, well, how much is uninsured? Ours is minimal. And I think what's important is that even if all your funds at a financial institution aren't fully insured, what's more important is that you have to look and see how financially sound is that institution. Are they going to go solvent? So to give you an example, in NCUA or credit union land where we live, the National Credit Union Administration, our regulatory body, basically tells credit unions, your net worth, if you were above 7%, you are considered well capitalized. And I think even Silicon Valley Bank said they were well capitalized. Well, by the definition of FDIC, they probably were well capitalized. Mm-hmm. But I think the question is, how well capitalized? Because in credit union land, if it's 7%, you could be 7.01%. You could be 8% and technically be well capitalized. But one thing that can happen in in tough economic times is it's nothing for a financial institution or a credit union to lose 200 basis points. So let's say that you're at 8% and things are going good, and all of a sudden there's like what we experienced in 2008 and 2009 with the economy, what we thought we were getting ready to experience and maybe still will experience with Silicon Valley Bank and all the questions and concerns about the financial system, is that if I am a bank or a credit union at 8%, and then that there's a 200 basis point reduction in my net worth and my capital, then all of a sudden I'm not well capitalized. I'm undercapitalized. So what I always encourage consumers to do is ask your financial institution or find out how well capitalized are you. To give you an example at Safe One, yes, the definition is at 7%, but we're more than 14% when it comes to our net worth. Okay. So we're double. And the argument will be, well, you're not, when you do that, when you're getting too high, you're not giving back to your members. And I just tell them, look at our website. We have the best rates in town. So who's giving back? Who's giving back and who's not giving back? And what that net worth really does, it's your rainy day fund. It allows you in good times when you want to go open a branch, you have the capital to do it. If you want to add products and services for your customers or members, you can do that. But what it also does in tough economic times is it gives you that savings account. It gives you that rainy day fund to take care of things that are probably going to be coming your way. So again, the main thing I tell people is that it's great if they say they're well capitalized, but you got to find out how well capitalized are they.
Yeah, you make a great point. And in kind of a post-mortem analysis of this whole thing, you start to realize that it wasn't just that isolated 7%, 8%, whatever the number is. It was also kind of a next level, next order analysis of how willing will depositors be to leave you in a hurry, and how quickly could that number vary? What is the volatility on that number? Is that 7 and it has no chance of going to 6, or is it 7 and it can go to 0? You know,
and I think one thing Silicon Valley Bank found out is that as loyal as they thought those customers were, when it comes to the dollar, they weren't that loyal. You know, everyone's got to look out for themselves when it comes to your livelihood.
They headed out pretty quick.
Yeah.
Do you guys find that you are able to make the claim like you just did about the highest? And when you say highest interest rate, you're talking about highest CD rate.
Oh, is that? We're always near the top of the mark, is what I mean. There's been, to give you an example, auto loan rates. There's multiple times when we're the best in the marketplace. Now, I'm not talking about the captives, like when you go to Toyota and Toyota's going to finance your car at 0%. We're not going to beat 0%. But what I do mean is that we are always near the top of having the best deposit rates as well as the best loan rates
financing
as well.
Rates.
Yeah. And what you'll find now is when I say some of the best deposit rates, to give you an example, right now, you're seeing all sorts of specials out there. You're seeing some that are going to be close to 5%, and it'll say 5% APY, but read the fine print. Is it a 9-month CD? Because that means you're not getting 5%. You're going to be getting less than that.
Yeah.
So my point being is that when you're looking at your financial institution, make sure they're well capitalized. If they are well capitalized, what are they giving you as a consumer? And so our moniker has always been, hey, we're going to give the best rates and the best rates we can. And I think Mary's been around long enough to know that we're always near the top of the list.
Well, and it's kind of a funny phenomenon now that the term CD is something that comes up again on a regular basis. You guys probably are being constantly asked about that. I mean, we can't have too short a memory that it was only probably a year ago or less that, and then the whole decade prior to that, that nobody even brought the concept up, right? Because there just was nothing to earn on a CD. I think that people out there are very interested in CD rates now. Do you guys find that you're getting people converting savings or checking accounts, portions of them to CDs just to earn that extra? Yeah. And is it typical to do 6 months or 12 months or what? Maybe you can kind of give me the rundown on what a typical CD looks like these days, without quoting rates. But I think that there's probably a lot of listeners who, if they haven't been in business or been having a savings account, say for the last 10 or 12 years, they're probably not aware of why would you have a CD or what is a certificate of deposit.
You're right. For years, certificates and CDs haven't been at top of mind for a lot of people. I think, once the economy went down in 2008, 2000, that was really kind of the end of those 5% rates that you saw. And I think in people's mind, the consumer's mind, and everyone's different, every individual's different, there's been some number in their head that they're waiting for. Is it 4? Is it 5? And once they see that number, then, now I can go put my money, I can take it out of something liquid like my savings or my checking or even a money market account. And now I don't mind locking it up for a year in order to get this, whatever's in my mind, this 4% or this 5%. So I think we are seeing some of that where people are seeing this, again, everybody's number is different, but they're seeing that number and they're going ahead and locking it up for a year and feeling comfortable about it. Yeah,
well, and I think people probably weren't even asking the question over the last decade because there just wasn't much to earn. So there really was no trade-off. They would quickly look at what a small amount of money they were going to earn on interest and just realize, well, why would I do that? Right? Exactly. It was kind of the default answer. But now it's actually a question up for consideration. Yeah. Because, okay, let me put my money in here and I lock it up. Now, remind me, what do penalties look like if somebody locks in their money on a 12-month CD and then decides they absolutely need it, say, in month 6 or 8? Is it prorated or?
It varies. Mary sees that a little bit more on.
So on the different, it really depends on the different terms. So on less than 12 months, it's 3 months worth of interest that you would have earned on the amount that you withdraw. Okay. So if you withdraw $1,000, it's 3 months what you would have earned on that.
Okay.
Over 12, it's 6 months worth of interest. So on the amount that you withdraw. So if you withdraw $1,000, it'd be 6 months of interest on $1,000.
And it's never the case that you just absolutely can't access those funds in a case of an emergency or something. It's just always a trade-off as to will you have to forego that interest you were going to make, right?
Right. Basically, when you put it into a certificate, you somewhat promise that you're going to keep it in there for the time period. So that's why there's a penalty.
Yeah, understand.
And we've seen
we pay higher.
Yeah. And we've seen such an acceleration of rates over the last year. Yeah. You could get an individual who had locked in for 1%, a 12-month CD at 1%, and then they saw the rate go to 4.3, and they said, well, I'm just going to break it because I can pay the penalty and make more money by just Mike. Putting it the 4 point whatever. Yeah,
good point, Mike. I could see that being the case. And then somebody who's going to lock it in today, say for 12 months, if there are some interest rate drops in the future, they've locked that in for 12 months.
Exactly.
And so they're not going to, it's not going to go down necessarily.
Yeah. And one thing I tell consumers is, let's say that you've done a 12-month CD and you're at 4.25, and then you see a month later that there's another rate that's 4.5. Don't kill yourself over it. Yeah. You're getting a good rate. You made a good decision. Hindsight's always 20/20. There's always a better deal somewhere. Yeah. But you did pretty good.
Well, so and in 12 months you get the opportunity to make another decision about what you want to do next, right?
So don't beat yourself up. You've made a good decision and be thankful for it.
So credit unions have the feature that you must be a member to join the credit union. So tell me a little bit about that. What membership requirements does Safe One have? What do you typically see as membership requirements for credit unions across the board? Is it tough to get in? Is it pretty straightforward?
Sure.
Tell me a little bit about that.
You want to start, or go ahead,
Sure.
Mary?
So Safe One, we're originally a California State Employees Credit Union when we started, and then we branched out to other areas. So SAFE actually means state and federal employees. That's one field of membership that we have. And then it was living in Kern and Tulare counties. We've now moved out to Kern, Tulare, Fresno, and Kings County. And we've also acquired what we call a community charter. And I believe community charters are very common, meaning that if you live in one of those areas, in one of those counties, you're now eligible for membership at Safe One Credit Union.
Okay.
So we did that, I believe, in the late 90s is when we went to a community.
Pretty broad then, as
Yeah.
far as qualifications. It's a pretty wide net that you're throwing out there.
And what Mary's saying is totally true. A lot of credit unions started with a single purpose. It could have been state and federal workers, or the firefighters credit union, or the policemen, or the teachers. And then over time, it's just, to your point, most of them have evolved to geography. In our case, the 4 counties, but not uncommon. A lot of credit unions have gone beyond that initial common bond to be open to the entire communities in which they're operating.
And if you think about it, it all has to do with once you've hit the market. So when we were Kern Tulare counties and we were state and federal employees only, and we hit that market, there wasn't any growth going on. We couldn't grow any further. So community charter really allowed credit unions to grow.
Did Safe One start here in Bakersfield?
Yes,
Okay.
on Chester Avenue.
And how long ago did you say?
1952.
Wow, been around a long time.
Yeah, 71 years this year. It's coming
Started
up,
with-
in fact, the anniversary date.
It started with 7 members and $305 in deposits.
Yeah.
Do you think that the trend is that you guys will continue to grow? Is that the
Yeah.
that the interest of management is to continue to grow?
Continue to grow. One thing you've heard me mention, the tough economic times of 2008, 2009. Safe One was one of the few credit unions in our area that never experienced a loss in any of those months. And it really goes back to what we talked about in terms of being well capitalized. The other secret sauce, if you will, that we have at the credit union, and Mary's lived in this for 35 years, is that we keep our operating expenses low. Our expense ratio is 60%. So what that means is it takes us to earn $1, we have to spend 60 cents. And the average is 75 to 85 cents for credit unions, or 75 to 85% is going to be their operating expense. So what's that mean? Well, that means that, some days I might be the one who's putting things in the file, or I might be doing, in what other organizations, what we consider menial work, but that's what we do.
Nothing wrong with that.
Yeah, no, we do it. We do that as a group to make sure that we keep our expenses low. And in turn, for the members, that means the better rates that we just talked about.
So if one of our listeners is thinking about getting into the banking industry, they're a young person, maybe they're going to college, or they're trying to figure out what to do. Maybe they're not such a young person, but just looking at that as a possible, great career or career change. What would you recommend to somebody who wants to get into the banking industry? Is it always start as the teller? Is it come right in and apply?
We did, yeah.
Or is there some bit of education or something that you'd recommend people having prerequisite before they come in?
Prerequisite. So credit unions, at least at Safe One, and granted that's my experience, is we have mostly hired within and then promoted within, except for the last few years, which then we've brought other people in that have actually worked in the credit union industry as well. So, but for most entry-level positions have been teller, and then they advance up.
Yeah. But there is that room for advancement.
Oh
yeah,
pretty quick.
Absolutely.
It sounds
Absolutely.
like,
yeah.
if you want to apply yourself.
Like Mary, I started as a part-time teller.
Yeah.
I didn't drive down the street and point at Safe One and say, someday that's going to be me there.
That's kind of why I asked that question, because I don't think it's something that you say, okay, I'm going to go to college I'm going to graduate high school, and what are you going to be? I'm going to be a teller at Safe One. I just don't think that's typically an answer, but it is where a lot of people end up working and then having a great career out of it. And I think it's just one of those unsung type jobs that people should be taking a closer look at in general, credit union and even the banking industry in general.
We have a lot of long-term employees.
Yes.
So at one time I knew what the percentage was, but I'm not sure now. But I am not the longest employee there. We have a lot of long-term employees.
Good.
It's a good place. It's a good place to work. I think credit unions in general is a good place to work.
Yeah.
Yeah, and there's always room, like Mary said, for advancement. It's if anyone asks me is getting into the credit union industry a good career move, I'd say absolutely.
Yeah. Yeah, good. Mike, you brought a bunch of paperwork with you today. Did we?
I didn't. Well,
was there anything we didn't cover?
Here's the deal. I didn't know what you were going to ask, and I just.
I've taken us all over the place, but now I'm going to turn it over to you. If there's anything in all that paperwork that we should be talking about, you tell me.
I wanted to be prepared because if you asked me something,
I thought maybe you had some loan docs for me to sign or something.
Well, what do you want? What can we help you with? No, I just wanted to be prepared because I didn't know what you were going to ask, and so if I had to think of something real quick, I could grab a piece of paper that I know somewhere in the pile here. So,
well, you haven't had to do that yet.
No,
you guys
it's been
are
good.
both pretty well versed in the whole industry. I really appreciate you guys coming on. It's been a great discussion. If people do want to find out more about Safe One after the show, we're going to have some show notes so they can always look it up there. But maybe you don't mind just kind of telling people where they could start by getting in touch with you guys if they have more questions in the future.
The best place is go to safeone.org. That'll tell you a little bit about our institution as well as what we have to offer you as a consumer. And then, you can always call the credit union as well. We do what we can to help make Bakersfield and all the counties we serve a better place. And I think we've been very successful in our mission, and we're really anxious about the future because we're going to be continue to grow with additional branches, more products and services, especially in the digital realm for our members and the community at large. So now's a very exciting time for Safe One.
Great. Thanks again, Mary. Michael, thanks for coming in. Appreciate it.
The show has been brought to you by the Law Office of Kyle Jones, Troy Burton with the Lynn Company, CPA John Duffield, Scott Hanson Real Estate Lender, broker and investor, Dave Plivlich, President and CEO of the Marcom Group and MarcomBranding.com, and Amanda DiGiacomo, President of Atlas Financial Solutions. You've been listening to the Our 2 Cents podcast. Check out the show notes for links and more information about the show. Also visit our website at our2centspodcast.com or catch us on Instagram at Our 2 Cents Podcasts. If you've enjoyed this podcast, please subscribe and share with others.